Small changes in growth assumptions can lead to ridiculous, impractical numbers. So when we're studying why something got to become as powerful as it has, why an ice age is formed, or why Warren Buffett is so rich, we often overlook the key drivers of success. Let's go back to Buffett. Currently at 91 years old, he has a net worth of more than $126 billion. A large portion of that, however, was accumulated after his 50th birthday, and $115 billion came after he qualified for Social Security benefits in his mid-60s. That said, those who attach all of Buffett's success to investing acumen miss an important point. The real key to his success is that he's been a phenomenal investor for 3/4 of a century. Had he started investing in his 30s and retired in his 60s, few people would have ever heard of him. So let's go through a Buffett thought experiment. Buffett began seriously investing when he was 10 years old. By the time he was 30, he had a net worth of $1 million, $9.3 million adjusted for inflation. But what if he was a more normal person, spending his teens and 20s exploring the world and finding his passion, and by age 30, his net worth was, say, $25,000? And let's say he still went on to earn the extraordinary annual investment returns he's been able to generate, 22% annually, but quit investing and retired at 60 to play golf and spend time with his grandchildren. What would a rough estimate of his net worth be today? Sadly, it's not going to be $126 billion. It'd be more like $23 million, 99.9% less than his actual net worth. Effectively, all of Buffett's financial success can be tied to the financial base he built in his pubescent years and the longevity he maintained in his geriatric years. That's how compounding works. Think of it another way. Buffett is the richest investor of all time, but he's not actually the greatest, at least not when measured by average annual returns. Jim Simons, founder of the hedge fund Renaissance Technologies, has compounded money at 66% annually since 1988. No one comes close to this record. As we just saw, Buffett has compounded at least 22% annually, a third as much. But Simons' net worth, as I'm making this video, is about $25 billion. He is literally 100 billion times less richer than Buffett. Why the difference, if Simons is such a better investor? Because Simons did not find his investment stride until he was 50 years old. He's had less than half as many years to compound as Buffett. Had Simons earned his 66% annual return for the 70-year span Buffett has been building his wealth, he'd be worth $63.9 quintillion. I've heard many people say that the first time they saw a compound interest table, it changed their life, but it probably didn't. What it likely did was surprise them, because the results intuitively didn't seem right. Linear thinking is so much more intuitive than exponential thinking. If I ask you to calculate 8 plus 8 plus 8 plus 8 plus 8 in your head, you can do it in a few seconds. It's 72. If I ask you to calculate 8 times 8 times 8 times 8 in your head will explode. By the way, it's 134 million. The danger here is that when compounding isn't intuitive, we often ignore its potential and focus on solving problems through other means because we're overthinking, because we rarely stop to consider compounding's potential. There are books on economic cycles, trading strategies, and sector bets, but the most powerful and important book should be called Shut Up and Wait. It's just one page with a long-term chart of economic growth. The practical takeaway is that the counterintuitiveness of compounding may be responsible for the majority of disappointing trades, bad strategies, and successful investing attempts. You can't blame people for devoting all their effort to trying to earn the highest investment returns. It intuitively doesn't seem the best way to get rich. But good investing isn't necessarily about earning the highest returns, because the highest returns tend to be one-off hits that can't be repeated. It's about earning pretty good returns that you can stick with and which can be repeated for the longest period of time. That's when compounding runs wild. So how long have you been investing? Comment your thoughts below. And as always, take care of your money.